I think we're good to get started. So good morning, everybody. My name is Andy Goodman. I'm a partner here at BDO. And we are here today to talk about share plans in the current UK economic environment. So I'm going to kick off just with a few little bits of housekeeping. Firstly, to say we're going to be doing some polling. So all of the speakers, I think, will be asking you to participate in a poll, which it's very easy. You can just use your mouse on your screen. So please do engage with that. It will help the session today, and also I'll follow up after the session. So thank you for that. Secondly, in terms of questions and answers, we've got some time for questions at the end. So if you would like to submit a question, please do so with the Q&A function, which should be at the bottom of your Zoom screens. If you move your mouse, you can submit questions, and then we will aim to answer as many questions as we can at the end of the session. And if we don't get to any questions, then we will follow up with the person who asked the question after the session. So just before we get into our material, just in terms of, I guess, a context around the current UK economic environment, some observations as to what that really means. So my first observation is that there are very few people working today who have run businesses and worked through an economy of low economic growth and high inflation. So this is a new world for pretty much everyone out there. And obviously, there are some people who've been around a very long time who may have seen it in the 70s, but they probably weren't leading businesses. And so everything that we're seeing, we're reacting to in real time, and that will continue to be the case. So we can't give you every answer. The second point is that it's very clear from looking at our clients that this economic environment that we're in is very different for different types of business. So you only have to look at, I guess, high-profile news to see how the largest oil companies are able to announce bumper profits off the back of what is going on. And then you can see that there are other businesses whose supply chains and their costs are being massively hit, essentially by the same economic effects, and therefore, depending on the sector you're in, the stage in the company's life cycle that you're in, the impact of this economy will be having a very different impact on your business, and therefore, again, there's no sort of one-size-fits-all answer. But certainly, hope that some of the material we go through this afternoon will help you with your thinking. So I'm now going to introduce our panel. So I'm Andy Goodman. I lead our Global Employed Services team in London. My day job is advising clients on the design and implementation of share plans and incentives for their staff and for their management team. Now I'll pass over to Nora.
Thank you, Andy. My name is Nora Sherman. I'm a director in the Strategic Reward Advisory practice at BDO in London. As my day-to-day role, I advise clients on all aspects of reward, starting from setting the reward strategy through to market competitiveness evaluation and incentive design, and advising on corporate governance matters and reporting regulations. I'm particularly passionate about helping companies implement the best possible employee value propositions for their people, looking at the reward and focusing on reward, of course, but also thinking about the career progression and development, well-being of their employees and the working environment as well. I work with management and remuneration committees of both publicly listed and private companies. And today I will be focusing on the implications of windfall gains for long-term incentive plans in the listed environment. Diane?
Thanks, Nora. So my name is Diane Elliott. I'm a principal in our valuations team here at BDO, which is a team of about 80 people. I lead our tax valuation practice, so I spend an awful lot of my day looking at the valuation side of the share plans and incentives that Andy and Nora work on, and also dealing with HMRC and getting their take on valuation issues and the various new things which come up from time to time. So I'll be talking about some of the impact that the current economic climate has on valuations this afternoon. And over to Matthew.
Thanks, Diane. Good afternoon, I'm Matthew Ems, I'm a tax partner at BDO, and like Andy, I advise companies on the establishment and operation of cash and share-based incentives. I work with companies' boards and remuneration committees to design, model, draft and implement incentive arrangements which are aligned with companies' business plan and, where possible, in a tax efficient form in order to lock in, incentivize and reward the employees. I just wanted to spend sort of 5 or 10 minutes just discussing the impact on companies of operating statutory tax advantaged option plans, such as company share option plans and EMI schemes, and also some non-statutory share-based incentives like growth shares and partly paid shares in a low or negative growth inflationary economy. Next slide, please. So I just really wanted to start actually just to kind of give some flavour to or context anyway in terms of the actual webinar. And the question here is your company, if your company has outstanding share-based awards, which many companies do, has the underlying shares decreased in value since the awards were granted? And then looking at the different types of awards, and you can answer to multiple numbers of these. So if you've got market value options, since some of those options were granted, is the exercise price on some of those now higher than the current exercise price? If you've got nil cost options or RSUs, the share price may have declined and the options may still be in the money, but has that share price declined since the date of grant? Same thing with ordinary shares. You might have employees that have purchased or subscribed for shares. Do you have any where the share price has increased since they were granted? And with growth shares, they might have a hurdle or a threshold which is higher than the current market value of the company. Or actually, are all your share-based awards in the money as it stands at the moment? If you could just answer those questions, you can answer one or more of those as applicable, and then we can move on through the session. Right, Natalie, should we just cut that and just choose it? Where are we on the stats there for that? Have we got the answers coming in? There we go. So we've got some market value options where the share price has increased. Also with the there's about a third actually that's actually where the share price has declined for RSUs, growth shares as well. And there's the fortunate 41% where all is well. So that's good to see. Okay, so let's move on to the next slide with that in the back of our mind. So first of all, just talking around company share option plans, and we move to the next slide as well. So I just wanted to quickly note at the very outset, just a bit of background with company share option plans, that although almost everything from the government's 2022 growth plan has now been scrapped, one of the key changes that survived some of these proposed changes was changes to the company share option plan legislation. So the proposed changes, which take effect from this April, increase the number of companies which can implement company share option plans. The changes increase the market value of shares at the date of grant that can be subject to tax efficient CSOP options from 30,000 to 60,000, and they relax the type of shares that can be used. So if we move to the next slide. So just a very quick background around the benefits of using a CSOP option. Effectively, the benefits of a CSOP option as opposed to an unapproved option is that ordinarily there is no income tax or employee or employer NIC on the exercise of the option, and instead employees pay capital gains tax on the amount by which their eventual proceeds, their sale pros, exceed the exercise price. However, one of the conditions with the CSOP legislation is that, unlike an EMI scheme, which can have an exercise price set below the current market value of the shares at the date of grant, the exercise price for a CSOP option must be set at or above the current market value of the shares when it's granted and agreed with the revenue. So what happens then in an environment where you're going into recession? So let's look at the next slide here, which talks about declining share prices. So the question, to a certain extent, depends on whether we think that the share price will recover such that the option will still lock in, incentivize, and reward the employees over the longer period. So if you think the share price is likely to recover, then the company can choose to leave the CSOP option as it is, or possibly grant some top-up CSOP options with a lower market value exercise price to bring down the weighted average exercise price of all of the outstanding CSOP options. And there's now more scope to do that now that the CSOP limit will be increasing to 60,000 from April. If the share price is unlikely to recover, then the company may wish to think about agreeing with the employees to cancel some of their CSOP options and grant new ones with a lower market value exercise price, but noting that this will restart the 3-year clock before the CSOP options can be exercised on a tax-efficient basis. For those companies that didn't qualify for CSOP options under the existing legislation and instead granted unapproved options, which are now underwater or with an exercise price which is higher than the current market value of the shares, there is the opportunity to cancel the old unapproved options and grant some new tax-efficient CSOP options with a low exercise price if the company now qualifies because of the changes. If the CSOP options were subject to financial performance conditions, consideration should be given as to whether the conditions are still achievable, and if not, whether they can be waived or amended to take account of the prevailing economic circumstances which we find ourselves under the terms of the CSOP rules. Next slide, please. So next, EMI options, similar sorts of questions, declining values. So the same question really applies as to whether the share price will recover. In addition, as previously noted, the EMI options can be granted with a discounted exercise price. So it's possible that despite the fall in the value of the underlying shares, the outstanding options may still be in the money. And that will be seen from the actual poll that we've just done, that the share price has declined, but it's still showing, obviously, that there's still value in those options, but not as much as there was at the point that the awards were granted. And therefore, whether there is value in those or not will depend on whether any underlying performance conditions can be satisfied. So if the EMI options are underwater, and the feeling is that the share price will recover, then the company could just choose to leave the EMI options out there, or possibly grant some top-up options again to lower the exercise price. So on average, the combined exercise prices drop down, and they're more likely to be in the money in aggregate. If the EMI options are underwater and it's unlikely the share price will recover, then the company may wish to think about granting some new ones and cancelling the old ones with potentially a lower or a zero price exercise price, but potentially over a fewer number of shares, because there may be more upside then for growth in the value of the business. But care needs to be taken to ensure when cancelling and re-granting EMI options, you don't breach the 3-year individual limit. So the next point, and I guess a question that needs consideration, is does the company now qualify for EMI in circumstances where it didn't before because of declining values? So it's possible that the underlying assets of the company or group may have fallen in value, then the company or group may now satisfy the £30 million gross assets test. And consideration should all be given as to how you calculate that gross assets test, because it's not that straightforward. It's also possible the company may have fewer employees due to potentially redundancy or natural wastage of employees in terms of people leaving, moving on, that we've seen over the economy in the last 2 years, and that the group may now satisfy the 250 employee limit. And if the value of the shares has decreased and old EMI options are released and new ones granted, then the company will be able to grant more shares within the 250 individual limit and the £3 million company limit. And for those companies that didn't qualify for EMI and now instead granted sort of unapproved options, there is an opportunity to cancel the existing EMIs and grant new tax efficient options should the company now qualify because of the reasons we've just talked about, sort of dropping gross assets and fewer employees. The next slide, please, Natalie. So next we're going to just talk about growth shares. And in short, when we're talking about growth shares, we're talking about employees acquiring a special class of share at the outset. If we go on to the next slide, please, which have rights to a value on a future exit. It could be at any event, but normally it's some form of exit. And the shares would participate in value above a predetermined hurdle, which is usually the value of the company at the time they're granted, plus a percentage over and above that. Such that on an exit, if the hurdle is reached, the growth shareholders receive an allocation of proceeds above the hurdle. And if the hurdle is not reached at the exit, they won't receive anything. So if we go on to the next slide. So declining values again. So where the value of the company has declined since the growth shares were issued, then we need to consider whether this is a temporary or permanent position. If it's felt that the growth shares will not deliver any value, then the company can consider reducing the value of the hurdle. However, when the market value of the growth shares is increased by things done otherwise than for genuine commercial purposes, it will trigger a tax charge in the increase in the value of the growth shares which are outstanding. There is an exception within the tax legislation where the commercial increase in the value of the shares is less than 10%. But for these purposes, we would look at any amendment to the hurdle to take account of the lower value of the business. That wouldn't be seen as a commercial increase. And therefore, you'd have to look at whether or not you breach the 10% limit. If the value of the company has decreased substantially, it is possible that any adjustment to the hurdle may not trigger a tax charge, but this would have to look at on a case-by-case basis. It's also possible that new growth shares could be issued with a lower hurdle, or that CSOP or EMI options could be used to be granted over the growth shares to avoid any commercial risk or upfront tax liabilities for the employees. If we go to the next slide, please. So partly paid shares. Quick overview on the next slide. In short, partly paid shares are where the employees acquire the shares upfront and the subscription price is left outstanding. So this is where the employees agree to pay the subscription price at the future date, such as when the shares are sold, at which point the employee has then funds from the sale of some of those shares. So what happens if those partly paid shares that you've acquired fall in value? If we go to the next slide. If the value of the shares has fallen below the value of the original subscription price, it's possible for the company to write off all or part of the outstanding call. Now, an income tax charge will arise here where the employee is relieved of an obligation to pay up the outstanding amount on the shares, other than on the employee's death. So the tax amount is any amount remaining of the notional loan immediately before the taxable event here, which is the loan write-off. Now, the tax charge arising is on the discharge of the notional loan is collected through pay as you earn if the securities are readily convertible assets. And here, nil, paid or partly paid shares are always going to be RCAs. And this is because the shares don't meet the conditions for the statutory corporation tax test and therefore are deemed to be RCAs. Because one of the conditions for the corporation tax deduction is that the relevant shares are fully paid up. So nil and partly paid shares here don't qualify for a CT deduction and therefore would deem to be. So therefore, you're going to have some Class 1 NIC, which is due on the discharge of the notional loan and on the amount subject to PAYE. Alternatively, the company could make a bonus payment to the employees, the net amount of which is equal to the amount by which the value of the partly paid shares has fallen, which the employees could use to pay in part some of the outstanding call, although this would have the same tax treatment as the discharge of the notional loan. I mean, ultimately, whether or not any changes are made to the outstanding incentives is a commercial call for the board of directors and the shareholders, weighing up the costs of protecting the employees from the downside of a declining share values, but at the same time ensuring that their key employees are suitably incentivized and locked into the company for at least the medium term. So now I'll hand over to Nora, who's going to discuss LTIP grants and windfall gains. Nora.
Thank you very much, Matthew. So we are going to take a very short break from talking about tax and explore a little bit more what companies who are experiencing decline in share price and windfall gains are really thinking about at the moment. But just to say, for those of you who are a major tax fans, please stay with us because Andy and Diane will be talking about tax issues very shortly. So having said that, can we move to the next slide, please? So 2023 is a really important year for, from a reward perspective, for two key reasons. Firstly, many companies who have awarded long-term incentive awards during the pandemic at a time when their share prices have declined significantly have awards that are due to vest this year, and investors are really looking at how remuneration committees will navigate the possibility of realizing windfall gains for their executives. And also, many companies will be putting their new remuneration policy to vote. So we expect that the implications of the vesting outcomes will also have will lead to key considerations of what companies would like to do in the future with their reward policies. But in terms of how companies out there are navigating the question around windfall gains, so the slide in front of you includes some real-life examples of how companies currently are dealing with this matter. It is focused on UK-listed businesses, and it looks at how they have managed this in the past couple of years and at the moment. So there are two key ways in which companies can address this matter. The first one is by adjusting the vesting outcomes of grants and current awards. And typically we see companies follow a number of approaches. The most common one is by choosing longer averaging period to determine the share price which should have been used on the date of grant, and determine what the number of shares that were awarded to executives should have been. They would then take this discount and apply it as a reduction to the vesting outcomes to ensure executives are not benefiting from windfall gains. Another approach that we have seen is typically applied by companies who have experienced positive performance impact as a result of COVID. So to bring this to life, this might be a supermarket who had higher profits than expected during the pandemic. So in those cases, these companies would typically remove the unbudgeted positive impact on performance and recalculate and reassess the performance against their vesting schedule. The alternative approach that we can see is companies looking at it proactively and determining what implications they should or interventions they should take with respect to their future grants. So many companies have actually come out to say that they will be reducing their future LTIP grants in order to ensure that in a few years' time, when the vesting comes, there will be no windfall gains for their executives. Again, similar to the approach when dealing with vesting outcomes, but companies will typically try to determine a higher share price in order to estimate the number of shares that should be awarded to as part of their LTIP grants. And it could be similarly either using an average share price or maybe using a share price with a reference to previous grants, for example. Some companies have taken an alternative approach of looking at their maximum LTI opportunity and reducing it for a future grants as either a one-off time arrangement or as making changes to their policy as well. In those cases, we see, again, a lot of variation at the market. Some companies might be reducing their opportunities by 10, 20%. And we also have companies that we have seen reducing them by 40 to 50% for future grants. It will, of course, depend on individual circumstances on the sector and how much volatility the share price of these companies is experiencing. And finally, we have included here an example, which is probably somewhat unique in terms of approach. And it is from a company that has experienced quite high volatility. So they have decided that for the next 3 years, they will be using their 2022 share price to determine the number of shares that will be granted to the executives. And they will take this approach in the cases where a share price is higher than 1.5 times their 2022 share price or less than 0.5 times their 2022 share price. So here they're really trying to strip out the high volatility in those cases. It would be great to get your views and see if you are thinking of taking this approach or either of these approaches. So if I may ask for a polling question to get your opinion on. Could you please vote for one of the following options if you are considering either reducing the vesting outcomes of your incentives, and option 1 might be by using a longer averaging period to determine your share price, or option 2 might be by using just an alternative higher share prices of different date. Or if you're considering making changes to your future grants, again, we have included here the 3 options: using a higher share price, reducing the maximum opportunity, or anchoring it to a specific share price for future awards, multiple future awards. Of course, if you are considering any other options, we would love to know. And if you're not planning to make any adjustments either to your vesting outcomes or to your future LTIP grants, that would be great as well. You can choose multiple choices as well. I'll just give you a minute to vote. Natalie, can I check if there are any responses coming in? Just gonna give you a little bit more time. So, can we have the responses, please? It's really interesting to see. So the majority of you are not planning to take any changes, but about 15% are probably looking at making changes to their future grants. Excellent. Another 17. If people are willing to put some of the suggestions or approaches they're taking in their Q&A, that would be really interesting to see. Thank you so much for your votes. Natalie, if we can move on to the next slide, please. So for those of you who work in listed companies, you will know how important the investor views are when considering executive remuneration or any issues related to incentive plans. We have included here 2 examples of investor views when it comes to dealing with windfall gains. In particular, the Investment Association has sent a letter to remuneration committees last year, urging them to apply discretion and review the vesting outcomes for potential windfall gains. In 2023, they are very keen for remuneration committees to apply discretion and very clearly explain the rationale for any reduction. And if the remuneration committees are not planning to make any adjustments, they should very clearly explain and disclose why they have decided not to do that. In their principles of remuneration, the Investment Association also has provided very clear guidance on what they expect from remuneration committees when it comes to making any discretionary decisions. In particular, they are very keen for remuneration committees to consider the financial performance and the share price performance on an annual basis and review whether grant levels should be adjusted in an appropriate manner. And if no discretion is being applied, then they would expect the review to take place upon vesting of awards to ensure that there are no windfall gains happening. The Legal in general have taken a slightly different view. They have very clearly stated that it is their preference to reduce the initial grant rather than the vesting outcomes. So they're urging remuneration committees to really be proactive with this matter. They would like to see a very detailed explanation to ensure how discretion has been applied and that appropriate adjustments have been made. And they have stated that they will be voting against remuneration reports where they feel that the remuneration committee hasn't really applied this thorough approach to determining what discretionary adjustments should be made, and or they haven't provided sufficient information to explain how they have reached their final decision. So something to really keep in mind. And if we can move on to the next slide. Thank you. So we now know what we are seeing in the market and what other companies are doing. We also know what the views of the investors in this respect are, but our clients are really dealing with the burning question of what the appropriate adjustment should be and what is really the appropriate discount and how we reach this discount in our thinking. And the truth is that there isn't a formulaic answer that will give you the right number. It requires a lot of judgment to be applied by remuneration committees. And in particular, we think there are several steps that they have to follow. First, it is really important to review your business performance and see how management has performed in the past 3 or 5 years over the life of the award. We recommend to assess the impact of unexpected circumstances, for example, as COVID was several years ago, on the business and share price performance as next step, and determine how this has impacted your business. As a third action, we recommend companies to compare the share price performance against the wider equity market, their sector specifically, or a relevant peer group, to determine whether they have been more strongly or less strongly impacted by the wider market conditions. Finally, we would always recommend to evaluate the impact of alternative pricing on the LTIP award. Have a number of scenarios in mind, which will allow you to determine a number of different models under which you can decide how many shares should have been awarded, be it by using an average share price or by using a different share price of a higher value from a different date. And finally, take the broader context of executive pay into account, as it is very important not to consider it in isolation, but also to see how management has approached the pandemic in terms of salary decreases or waiving of a bonus or previous vesting under your long-term incentives. It's very important to take this into account as well. So I'm going to pass to Andy now, who will be talking a little bit more about the tax implications.
Thank you, Nora. As Nora said, I'm glad to see so many of you who love tax have hung on for some more tax. Hopefully my acoustics or my sound is a bit better now I've thrown my headphones out the window. So I'm going to talk a little bit about sort of company reorganizations and business restructuring. So really thinking about the private equity backed, VC backed type of business, and just building on some of the things that you've heard from Matthew and Nora in the kind of arenas they've been looking at, but putting it into the context of that type of business. So if we could go on to my first slide, please, Natalie. So this is me just by way of a pretty rudimentary picture, trying to show what the issue is potentially in the context of this type of business. So this is trying to show how a traditional waterfall might work in one of these types of business, a private equity backed business, or maybe a VC backed business, where the value of the business, if it were to be sold, flows into what we call the waterfall, and then essentially builds up depending on what the value of the business is worth. So first of all, it will go towards paying off any bank debt, then shareholder debt, then preferred equity, ordinary equity, and the sweet equity kind of sits at the top of all that, so that once the investors have had the return that they would expect on their money, then the sweet equity will share in the super returns that these businesses are hoping to make. And I guess normally when a business is acquired through a leveraged deal, we're starting at around about where the top arrow in this diagram is pointing. So you've geared up the business with bank debt, shareholder debt, and maybe some preference shares, and management might hold some of those preference shares. And the business after costs and things are probably coming in such that the enterprise value of the business is somewhere just below putting value into the ordinary equity. And so a management team takes over running the business, and they will say, excellent, well, we think we can really supercharge the business here, really make it grow. And then once we've added some value to the ordinary shares, our sweet equity will come into value, and we can make plenty of returns. And that's a really big part of the remuneration package of high quality management teams who would be running this type of business. In some cases, we might find ourselves now where through the pandemic, through the impact of the war and so on, a business might find itself at that arrow down nearer to the bottom of the diagram there, where the sweet equity looks a long way from delivering any value to management. And clearly, if that's because management have underperformed, then the company and the owners would say, well, we've suffered, and clearly you should suffer as well. But in many cases, the owners might still be sitting there thinking, well, we've still got the best management team in the business. We've got people that we would trust to turn this business around, but they need to be incentivized, and they need to feel like there is some returns for them that will potentially reward good performance from here on. And if we're sat somewhere in that bank debt element of the stack, it may feel like we're never going to get value out of our sweet equity, and therefore we need to change the incentive. So that's the challenge that businesses are facing. And then the question is, well, how do we get them into some kind of return further down this stack? So if we could go on to the next slide, please, Natalie. I think that whilst there might probably be about 15 different ways that businesses would try and address this, I think realistically they boil down into three. So the first is to say, well, we need to amend the terms of the existing management incentive plan. Now, clearly that depends what the existing management incentive plan and the suite equity looks like. But if the suite equity is a class of shares, we might be changing those share rights to mean that actually they can participate in value at an earlier point in time. The second piece would be to issue new securities to management. So maybe they might get some of the investor preference shares, or they might get some of the investor ordinary shares, and they might be issued to management so that actually they are now sharing in value further down the chain, but still holding onto their suite equity in case they're really able to turn things around and deliver super returns. And then thirdly, gifting some of the investor securities to management. So it may be that the institution might even be willing to give some of their loan notes to management so that management are aligned with the investor, who would actually feel that getting a lot of their money back on those investor loan notes is actually a good return to them. So I would say there's three approaches that that an investor or private equity house or a venture capitalist might make to try to address the issue with management not being fully incentivized in the business. And now we'll go on to my third slide, please, Natalie. So I guess the key point here is that once a business has worked out what would be the right change to make to the incentives so that the investors feel like they are, I guess, still likely to get the best possible return on their money, despite potentially coming through some adverse situations, many of which might be external, but also feeling that management have got a real incentive to drive the best possible return. The question around how you deliver it, which of those three approaches that I've set out there is the best approach for a business, it is influenced by the tax treatment. Now, whilst the fact that so many of you have stayed on the line shows that there's a real love of tax amongst our audience today, I think it would empty the room if I tried to go into too much detail around the decisions that you have to make. So I've kept the tax analysis here pretty high level, but just to give you a flavor of the things to think about. So the first point here is this question around, can equity rank ahead of debt? So it's not always that straightforward to for an investor to just give away some of their loan notes, and it may well be that they might be happy for management to share in some of the debt, but maybe they would come into their kind of share of that debt not at the same time that the investor does, but maybe halfway through, for example. And that means that often the preferred commercial route here would be to set out the commercial goal, which is management will come into value at this point and this is what they'll get. But actually you deal with the mechanics at the point of exit and say, okay, well, if we need to waive some debt or if we need to just reallocate proceeds on an exit, as long as we can document our intention, then everyone should be happy. And everyone should be happy until you look at the tax implications, which may well mean that you're pushing any income tax charges to the point of exit, which may be okay. But if management are hoping to make significant amounts of money, it's likely that that will push that into the employment income tax, that pays you earn and national insurance arena. So therefore, that might not be the best route, which is just essentially say, we'll deal with this at a point in the future. The second question is around benefits in kind. So this essentially follows the point that Matthew made, which is if you're lowering the hurdle on a growth share, if that makes the employee's equity more valuable, then they should expect to pay some income tax on that. And it's the same here. If you are changing the terms of management suite equity, and that makes that suite equity more valuable, then management should expect to pay some income tax on that value. Unfortunately, we have Diane here who can talk a bit about value after I am done. Now, the specific taxing provisions that can give you those income tax charges differ. And I've set out 3 there: general earnings, non-commercial increases in value, and special benefits. Now, they're kind of technical terms that we are happy to throw around in our teams, but in practice, what that means is that if you try to deliver this outcome in a different way, be it changing the terms or giving new instruments, you will get a tax charge under a slightly different section of the tax rules. And that could have quite a significant impact on how that plays out. So you do need to know that what might seem like a simple, well, what approach do we fancy? That might have quite a different tax implication. And finally, there are also some non-PAYE issues that need to be thought about. So if essentially value is being passed between different shareholders, that can have capital gains tax implications, essentially for those who are losing value, because it could be seen as a disposal on their part. And also, if we were to issue new loan notes to management, it may be that those could fall under the deeply discounted securities regime, which gives rise to further income tax charges on exit. So all complicated stuff. I certainly wouldn't feel I've given you all the answers here, but hopefully I've set out some things for you to think about if you are going through this thought process around restructuring your MIP. I will now pass on to Diane, who can feed into all sorts of different valuation questions that the other 3 of us have raised.
Thanks, Andy. Lots of things to think about there. And so I thought I'd start off just giving us a little bit of a reminder, just as Natalie, if you want to flip onto the slide, side hustle, as well as just tax valuations, is that we also lead on matrimonial valuation practice. And it's been quite interesting, just as an aside, that there is a lot more tendency, or people are now getting divorced, whether it's just the effects of 2 years of lockdown. Everybody's decided they either love each other or they really hate each other. But also for people who have been planning divorces, they are seeing that this could be the best time, if they are business owners, to actually negotiate a settlement, because the values could be lower than ever before. So that's kind of as an aside. But actually what we're doing here when we're valuing incentives is we're going to value on a tax valuation basis, which is sort of a pretend construct that doesn't often correlate really very much with the real value of a business. And certainly, I have clients who think, come back to me and say, if you think I'm selling my business for that, you must be mad. But the reason why we get a difference is the valuation basis is really just generated from 100 and odd years of case law. So you get all these little snippets from various cases, and you end up with this kind of very bizarre construct. So for most employee incentives, we're going to be valuing very small minority holdings. That isn't always the case, but generally speaking, the management equity pot will be a minority shareholding as a class, and then people are getting a small shareholding within it. Because you're deemed as a minority shareholder only to have access to limited information, it's generally information that's only in the public domain. So things like published financials, press releases, market opinion, little comments of whether somebody's opened a factory or is closing a shop or whatever it might be. So if you think about the information that might be in the public domain, if you've got a December year-end company and you're looking at shares today, you might only have the December 21 financial information on which to make your investment decision. So clearly that's going to be very out of date. It would be very hard to know whether the company's performed better or worse or differently. So there is a sort of view that if the information is massively out of date, that what you should be doing really is saying, well, is the company performing better, worse, the same, completely differently from the last available financial information? You might not get chapter and verse, you might not be provided with detailed forecasts, but you would expect some sort of indication as to whether or not the company is performing as it was or in a different way. The other thing to bear in mind is if we're valuing unrestricted or actual market value, which is usually the basis for employee incentives, you ignore the fact that the purchaser of the share is an employee. So, you can be sitting with the CEO or the CFO, and for tax purposes, their only characteristic is that they are an acquirer of this small minority shareholding. Doesn't matter whether they've got shares already. It doesn't matter what their role is in the business. So again, that limits and restricts the information that they may be deemed to know. So if their only characteristic is that they are a potential acquirer of the shareholding, that can give you an awful lot of flexibility and an awful lot of assumptions to be made when you're valuing shares. So Natalie, if you can flip on to the next slide, and then we can just remind ourselves, Andy did a lovely diagram on equity and enterprise value. I did not do a diagram, but if I'd known he'd done one, I'd have copied his. So in very simple terms, if you've got a trading company and we are valuing that business as at today, you would take maintainable earnings times a multiple, and if you've used EBITDA, you will get to an enterprise value. You take off your interest-bearing debt, you add surplus cash if you have any, and then you get your equity value to be shared among all the various different classes of share. So the valuation basis itself is pretty straightforward. If you're then asking yourself, well, has my valuation changed since maybe I put in the management incentives? And is there anything to be concerned about? All you have to ask yourself is, of all those various moving parts in the calculation, has anything changed significantly? If the answer is yes, then it's possible that your valuation may have changed, either for good, if you're in the position that you've got a windfall, as Nora was talking about, or possibly there's been a downwards slide because earnings have not been as you'd be expecting. So if you want to pop to the next slide, Natalie. So if we think about how that might impact something like a growth share, the guys have talked about growth shares, and everybody seems to have them. They're kind of flavour of the month as far as incentives go, and there's clearly a lot of sense in that, because they are designed really to reward super performance and outperformance, and if they do outperform, the returns can be quite substantial, but the upfront cost can be quite low. So that's the sort of benefit from a valuation point of view. And as you'd expect, the valuation basis for growth shares is very forward-looking. Now that's completely at odds at what I've just described in terms of the tax valuation basis, which is basically public information only, take your best guess as to how the company might be performing and on you go. So there is a sort of expectation that some sort of forward-looking calculation would be prepared here. And what we're trying to work out in very simple terms is, what might these growth shares deliver? When are they likely to deliver it? And what could mean that actually the shares are derailed because the hurdles and the targets aren't met? So that's always what we're doing. We're looking at how things are going to go. If you're looking at your company's performance as at today, and there may have been a dip or a lovely peak short term, but long term, you're expecting everything to go back as you expect, there may not actually be any change to the value of your growth shares, because your long-term forecasts may be exactly as they were before. However, just thinking back to the previous slide, if there were any changes in those main components, then you might have actually changed the value of the growth shares, and things may either be more or less valuable than they were before. If I could have the next slide, Natalie, that would be lovely, thank you. So some of the things that we see, we have listed company clients, and their growth shares were based on the achievement of a particular share price target. Now, notwithstanding their own performance, because there's been a general downturn in the listed markets, that share price may no longer be viable or achievable within the expected time frame. That may have nothing to do with the company's own performance, just the general downward pressure on the market. The timing of a potential exit event may have changed. Again, companies which might have been looking to exit maybe in 3 years might be pushing it now out to 5, because they want to make sure that the earnings are as high as they can possibly make it. It could be actually that the earnings, the exit period is going to be a lot shorter, because somebody might be making an offer you can't refuse, and you just decide to cut your losses and exit sooner rather than later. Again, that might mean that there's no value in the growth shares now, because the company hasn't had time to build up that growth and the targets to be achieved. There may be additional debt financing, or the debt costs might be going up over a period of time as interest rates have risen. And again, the more debt coming off that enterprise value calculation, the lower the equity value is going to be. There might just be generally a greater level of risk attaching to your forecasts. The world is a less certain place than it was before, and therefore you might have always been within 5% of hitting targets historically. That might now be 10% or 15% due to matters outside of your own control, usually external cost pressure. So some things that we're seeing, companies where you have prepaid utilities, costs for a particular period of time, if they're coming to an end, the new repricing may be much, much higher than you were originally expecting, and your forecast will need to be revised accordingly. Costs of raw materials could now be massively understated. I guess if you're in the restaurant sector and you're trying to buy a tomato or a cucumber this week, that's going to have an impact on your pricing if you can get them at all. Staff costs, you may struggle to get enough staff to deliver your forecasts, and the price you may have to pay them, that the wages may just have to be that bit higher. You've also got the general economic impact, where if you're in a sector where you are reliant on consumer disposable income, people are feeling the pinch because mortgage rates have gone up, there may be less discretionary spend in other sectors. Finally, you might also have to do some sort of fundraising activity, and again, depending on the sector you're in and the nature of the fundraise, you may find that might be, you might have to give away more than you expect. You may have to give more priority away on the equity in terms of preference, and therefore the equity waterfall that was so nicely set out in Andy's diagram might be impacted accordingly. If I could have the next slide, please, Natalie. So other things to think about. As Nora's pointed out, it's not all gloom and doom at the moment for management incentives and for companies. But things to think about, where some of my matrimonial clients are going wrong is they're thinking, my earnings last year were not great. But actually what we're trying to do here is work on maintainable earnings. So what can you reliably make year on year on year? So if you have got exceptional costs going through, or one-off hits and non-recurring items, we would adjust for that in arriving at maintainable earnings. The upside for that, or the good side, if you're in a windfall situation, is that would also have a downward impact on your current earnings, because if they're not expected to recur, we would take that windfall out of the calculation. For companies where there's been a significant debt write-off or conversion into equity, conversely, the value of the increase may actually apparently have gone up, because that enterprise to equity value bridge has been affected by the fact that the slice of debt is now a little bit lower. One important thing to bear in mind is any fundraising activities or transactions in the shares might impact the share value, which you agree with HMRC. Again, if you have put in EMI valuations or CSOP valuations, you'll know that there is a belief and a view that HMRC will use any transaction as a benchmark if they possibly can, if it looks like it's an arm's length transaction. So you need to be very aware and conscious of that when you're preparing your valuation, whether that is a benchmark or whether you need to distinguish it for valuation purposes, or you might find that that has become your new valuation. The other thing to bear in mind is, again, a very positive point for companies who are looking at an exit. We have seen a lot of transactions in the market which have taken place at multiples much higher than we could ever have envisaged. So, the market data might be showing a multiple of maybe somewhere between 10 and 20, and companies are exiting at 40 or to 45. The practical point around that is, if management incentives have been issued fairly close to the transaction date, it will be a due diligence question, almost guaranteed, because it looks as if the shares might have been issued at too low a value. That may or may not be the case, and my tip would always be to document very carefully the timeline of any activity. so it's clear who could have known what when in terms of the sort of the valuation timeline. So those are sort of the key points that I just wanted to raise. I do have a question for you all, for those of you who are still hanging on in there, so thank you very much for that. And it picks up on some of the points that Matthew and Andy raised. So if you can pop the poll up. I'd be very interested, now that there's a change to the CSOP arrangements, whether anybody is planning to use growth shares and CSOP in combination, because obviously the benefit of that is you can have your growth share valuation agreed in advance of the issue. And so if you are thinking of doing that, or you are absolutely not thinking of doing that, please, if you could vote now, that would be great. And Natalie will tell us when we have got a response to that. So I think I'm going to hand back to Andy, and we've got time for any questions if you have them. Natalie, if you pop the results up, there we go. Okay.
So Diane, I'm not sure whether all of our guests can see that result actually. So
we have 25% of the online participants who are considering using growth shares and CSOP arrangements, and 75%, which is a resounding majority, saying no. So thanks very much for that. That wasn't actually the answer I was expecting, so that's quite interesting. I think HMRC might be relieved, frankly, because I'm not sure how they're going to cope with an influx of growth share valuations.
thank you, Diane. Thanks to all the presenters. We do have a few questions, so we will run through a few questions. And for those of you who have got time, they are some interesting ones. So if you are able to stay on the line, please do. Actually, Diane, while you're there, we'll start with you. Actually, how often are HMRC challenging share values? Is the question we have that I can direct to you.
Well, that's a very good question. And anecdotally, I am hearing that HMRC are challenging valuations more than they did before, particularly when there has been some sort of transaction in the shares immediately preceding, some sort of fundraise or EIS issue or something like that. I am not seeing it as much, is the honest answer. I'd like to say that's just because I'm a fabulous valuer, but I think, it's there but for the grace of God for everybody. What we are seeing, though, is a lot of challenge on due diligence exercises, because the multiples on an exit are now so much higher than anybody could have envisaged. It's making a lot of the historical share issues look as if it's at quite a low value. So there's been quite a lot of discussion in that front.
Brilliant. Thanks, Diane. Matthew, could I ask you, we've got a question here that says that you mentioned in there that there is an interaction between the CSOP £60,000 value limit and the EMI £250,000 value limit. Can you elaborate?
Yes, I can. So the EMI limit is currently 250,000. The CSOP limit currently 30,000, increasing to 60,000 in April. So when you're calculating the EMI limits, you do need to take into account the unexercised CSOP options. So if you're looking at the calculation of an individual limit for EMI, you look at all EMI options that are granted and outstanding at that point, which haven't been exercised. Any options which were originally granted to the employees that have ceased to qualify because of a disqualifying event, you take those into account, together with any unexercised tax-advantaged CSOP options that the employees hold that have been granted by any member of the group. And you look at the aggregate, and obviously that cannot then exceed the overall EMI limit of 250,000. So there is an interaction in there when you've got both CSOP and EMI outstanding options.
Okay, thank you. So people who are looking at doing, well, having both of those plans, then you should definitely get some detail around that, I think. Nora, there is a question for you.
Sure.
How should companies approach engagement with their shareholders when discussing some of the adjustments to LTIP vesting that you set out?
It's a It's a very good question, Andy, and I guess there isn't a right or wrong answer for companies, but there are definitely a couple of things we would recommend companies to follow. It is, as I mentioned in the presentation, investors will have their own specific views on the subject. So we always recommend be aware of what your major shareholders are thinking in this space and what they expect to see from you. And also be aware of how they would like to be engaged with. A lot of the shareholders would like to have an opportunity to feedback and be part of the discussion, and they do not like to be presented with an answer, whereas there are other shareholders who are happy to review the final conclusion that Remuneration Committee has come up with and feedback if they have any concerns specifically with those. So it's very important to go to your shareholders and approach the different shareholders in a different manner. As I mentioned in my presentation previously, I would recommend always do your homework. So prepare for these conversations by looking at your business performance, looking at what's happening to your share price, looking at the implications of the decision on your remuneration policy and any other decisions you have taken as a remuneration committee in regards to your remuneration policy as well. And finally, be very clear when you present it, very clearly explain your rationale and ensure that your shareholders are aware of all the considerations you've taken.
Okay, thanks, Nora, that's very clear. And I will pick up one last question that we've had in that I can direct to myself. Otherwise, I will get a hard time from my fellow panelists for taking it easy. So the question that I can pick up is, if management have paid income tax on their sweet equity, can they reclaim it if the value of their shares falls? So you get shares that have a value, they're worth say £10,000, and say you end up paying about £5,000 in tax and national insurance. If your shares become worthless and you don't get any proceeds, can you get that £5,000 of tax back? So the simple answer to that is no. That tax is essentially risk capital on behalf of the management team. If the value of their shares becomes worthless, they will be making a capital loss because they've essentially paid income tax on the initial value, which in that example I gave you was £10,000. So they have made a capital loss of £10,000, which they can offset against other gains. So there is a recognition of the loss, but you don't get your income tax back. And whether and when you can utilize that capital loss is less certain. And also it would be at capital gains rates, which currently 20% rather than the income tax rates, which are up to 45%. So there is your answer on that one. We will call it a day on the questions there. For any that we haven't answered, we've got a record of everything. So we will email people who've asked questions that we've not been able to answer. So please don't feel left out. So that just leaves me to say thank you very much to our panelists. And more importantly, thank you very much to all of you guys for joining us. We really hope that you've taken something away from it, that it's been useful, and that we get to see you again at some of our other webinars in the future. So thank you and goodbye.